As I'm sure you know, one of my largest investments right now is in GameStop. And there is a high probability that GameStop will go through a short squeeze soon. But this GameStop short squeeze is not unique. Actually, short squeezes happen more often than you think. And some of them are bigger than that of GameStop. There is one currently which is worth trillions of dollars and nobody's talking about it. In today's video, we are going to talk about short squeezes in general. We are going to look at the GameStop situation. We are going to talk about other short squeezes that happened recently and the multi-trillion dollar one which I want to focus on in the coming month. I am a fundamental analyst, and in general, short squeezes is in the realm of technical analysis. And I don't really believe in technical analysis, but when we look at short squeezes, this is something that actually makes sense. One of the rare cases when technical analysis is actually working, because you need to understand how the stock market itself works. If you can understand that, then you can understand why short squeezes actually do work. And if you know how to properly play a short squeeze, you can make a lot of money. But at the same time, if you play it the wrong way, you can lose a lot of money. Before we talk about how to make money on short squeezes, please make sure to smash the like button for the YouTube algorithm. If you're new to the channel, my name is Ishfaq. I am a popular investor on eToro where I manage assets for 138 people. So please subscribe and hit the notification bell so that you don't miss the coming videos. Let's start by talking about GameStop itself, because I think this is the most familiar short squeeze we are having right now, and this is the most interesting one to talk about if you want to make money in the coming month. So GameStop, this is a business in decline, and consequently many people understood that if you want to make money on that stock, you should short it. So how exactly does shorting work? Let's say you are betting against a company, you want the stock price to go down. So when you're going to short it, you will ask someone else who already owns the shares of the company to loan you the shares. Let's say the shares were at $50 a share. Now you sell it to the public. You sell it on the open market. After a few months, if really you were right and the price of the company's stock dropped, you buy back those shares. Let's say now they are costing you $40 each. And you return the shares to the owners of the share. So you have made a $10 profit. Now you may ask me the question, how the owners of the shares make any profit from that investment? Of course, you have to pay them an interest, so a fee. So let's say per share, you're not making $10, you're making only $7 because you paid them a $3 fee per share. So this looks like a good deal. This is how shorting works in general. And the same thing has been happening to GameStop in recent years. Let's say 5 years ago, the shares of GameStop were about $50 a share, and you were shorting 1 million shares of GameStop. At the time, it would be about 1% of float. The float is the total number of shares in theory that can be traded. Now today, if you're going to buy back those 1 million shares, because let's remember, if you want to make profits from short selling, you have to buy back the shares eventually. You cannot just keep the shares, let them keep going down. Eventually, you will need to take profits and you will need to buy back the shares. So now these people who were shorting the shares of GameStop, let's say over a 5-year period, they shorted the shares of GameStop, made over 90% profits, good for them. Now they want to take their profits. If they are going to buy back the shares of GameStop, that 1 million shares today is 4.5% of float. It's because GameStop over the past years have been buying back their shares. Even the insiders of GameStop have been buying shares. And today, the float of GameStop is very limited. If that 1 million shares were 1% of float, it may not have such a big impact on the stock price. But if you're buying 1 million shares and it is 4.5% of float, it will have a big impact on the stock price. Because when you're trying to buy those shares, the broker, the market makers, they will need to find people who are willing to sell the shares at this price. And when those people see that there is a high demand, someone wants to buy the shares, those people who wants to sell, they want to make maximum profits. So they will try to sell at a higher price. When they try to sell at a higher price, if the broker cannot match a deal for you, they will tell you that you cannot buy at, let's say you are buying at $8, they will tell you cannot buy at $8 anymore. You have to buy at $9 because only people are willing to sell 1 million shares. It has $9. So this is how brokers and the market makers try to make deals in the stock market to keep it liquid. A short squeeze will happen when there is a lack of liquidity, so they cannot find the deals. Now, someone wants to sell not at $9 but at $10 because they see the pressures mounting here. Those short sellers, they want to take maximum profits, so they want to buy as soon as possible, as fast as possible. But the more demand there is for the shares, the more those people who want to sell the shares, the more profits they want to make. And maybe those people who want to sell the shares also, they don't want to sell it anymore because they see the price is going up. So there will be this situation we call a short squeeze, where the liquidity of the shares are limited. There are too many people who want to buy the shares and not enough people who wants to sell the shares. And of course, anytime this happens, the stock price will just go up. If you want to know how the market works, you can always join my research partnership, where I have a course investing for beginners there, or you can even buy the course separately if you want. You will learn more how the market works in general. Now let's look at two other examples of short squeezes which happened recently. The number one I want to talk about is Tesla. This was in absolute term the largest short position. The amount of money that people were putting to short Tesla, this is a record high. But when the stock price of Tesla were going up, of course, those people now who are shorting the company, the stock, they want to take maximum profits, or they want to cover their position to avoid losing money. So this is what happened. And today you will see that the number of shares of Tesla being shorted is not that much actually, because the stock price just went up and people stopped shorting the stock. It was too risky to short the stock. The record percent of float of Tesla which were being shorted is 60%. But this is nowhere close to that of GameStop, which is currently at 250%. And if you look at the shares outstanding of GameStop being shorted, it's at 85%. Another short squeeze which happened this year is Blue Apron. This company did its IPO a few years ago. It performed poorly, everybody was shorting the stock, but now this pandemic happened. With the pandemic, it was a good news for the stock, and the stock price started going up. So the short sellers had to cover their positions and they triggered a short squeeze. And again, the float of Blue Apron being shorted is nowhere near that of GameStop. We need to understand something about GameStop. There are many activist investors involved. For example, there is Michael Burry, who owns 4.5% of the company. There is Heisha Capital and Permit Capitals. Those hedge funds own about 7% of the company. We have the insiders who own 14% of the company. We have Ryan Cohen, who now owns 9% of the company. So these people together, they own about 35% of the company. So if these people now do not want to loan their shares anymore, this will automatically trigger a short squeeze. So these people, let's say, I don't know how legal this is, but if these people goes behind closed doors and make some kind of deals that they will just record all their shares for some reason, maybe they want to have a proxy fight, stage it or something like this triggers a short squeeze. But I don't think this is legal and they are going to do it. But you understand the situation. People are betting so much against GameStop that they are digging their own grave. The best example of a short squeeze I can talk about is Volkswagen Group. It happened in 2008. At the time Porsche was trying to acquire Volkswagen Group, they were buying the ordinary shares of Volkswagen Group. At the same time, there were the preferred shares being traded. There was a financial crisis, automobile stocks were going down, the preferred shares were going down. But because the demand for those ordinary shares were going up, the ordinary shares were going up while the preferred shares were going down. So arbitrageurs saw this opportunity that sooner or later things will need to return to the mean, that the ordinary shares were too high, so they began shorting the ordinary shares. It looked like a normal arbitrage deal. 50% of the shares, ordinary shares of Volkswagen Group was owned by Porsche, 20% was owned by other institutions. So we had about 70% of shares outstanding which were not being floated. And if 10% of the shares outstanding were being shorted, there was still about 20% of shares left to cover all these shorts. So it was still a good deal. But then on a Sunday afternoon, Porsche announced that now they no longer own just 50% of the company, but they own 74% of the company. So if they own 74% of the company, you make the calculation again, you will see that to cover the 10% of shorts, there were only 6% of float available. The next morning, the shares of Volkswagen Group went up. It gained more than 400% in a single day, and Volkswagen Group on that day became the largest company in the world. It was only one day, but it became the largest company in the world. Some people, those who were betting on Volkswagen on the ordinary shares, who saw that short squeeze coming, they were able to make money. But unfortunately, there was one of the richest men in Germany, was I think the sixth richest man in Germany. He was betting against Volkswagen ordinary shares. So he was shorting the stock, and he lost a lot of money. After a few months, he committed suicide. Another example I can give you of a short squeeze is in 1987 during what we'll call Black Monday. Of course, it is not the main reason why there was such a big crash, but it all started because of a short squeeze. People were trying to hedge stock market gains. The stock market was in a bubble at the time. Everybody was happy, but they wanted to hedge, so they were shorting futures contracts of indices, and at the same time they were buying stocks. So this eventually caused a short squeeze. There were not enough liquid shares to cover the short positions on those indices. I won't go into details about this because this was a very complicated day, and like I told you, it's not just the short squeeze which caused that, but the Paul Tudor Jones was able to see that there was a short squeeze coming, and he shorted the market. So he was able to make money by shorting the market. So he knew what was coming, and it's based on seeing a short squeeze when nobody else saw it. We are going to talk about the 19th of October 1987 on another day because there's too much that happened on that day to talk in this video today. Let's talk about the $1 trillion short squeeze happening today. Many countries take their debt in US dollars. So their debt is denominated in US dollars. So these countries, in other words, they are shorting the US dollars. Because if you think about it, let's say Russia takes a debt in the US dollars. In order for them to repay the debt, they want the Russian ruble to be stronger than the US dollar. So they want the US dollar to weaken. In other words, they are trying to short the US dollars. But when these countries now face a problem, that they do not have enough US dollars to repay their debt. If your debt is in US dollars, you have to repay it in US dollars. They will demand more and more US dollars. When the demand for US dollars increases, this makes the US dollar even stronger. And this is what causes a short squeeze in the US dollars. They are trying to weaken the US dollar, but at the same time, in order to do that, they will have to make it even stronger. And this is what caused many countries in the past to have financial crisis. For example, recently we had this with Turkey and also Argentina. This is something that I'm following very closely because I'm trying to diversify away from the United States. And whenever I'm investing in a country, I want to know if that country has a good or bad debt. Because if you are taking a lot of debt in United States dollars, and then you cannot have dollars to repay it in the future, it's not a good thing. In general, short squeezes, like we said, are interesting situations in the market. It is more technical analysis than fundamental analysis. But whenever you are trying to make money out of a short squeeze, I will suggest to you that look at the fundamentals first. I did not invest in Blue Apron. I did not invest in Tesla because these short squeezes were based solely on technicals. While I'm investing in GameStop because this company, this short squeeze, it is based on fundamentals. The main reason why I'm investing in GameStop is not because of a short squeeze coming. It's because I see the value in that stock. The company can generate more cash flow over the coming years than current market capitalization. The company has more cash than debt. They can buy back shares. They can eventually pay dividends. That's why I'm buying shares of GameStop. The short squeeze, of course, I will be happy if it happens, but this is not the main reason why I'm buying GameStop. This is only like a luxury item coming. It's like buying an iPhone. If you buy an iPhone, you don't buy it because it's a luxury product. You buy it because you want to use a phone. It's a luxury product, of course, it makes you happy. That's good. But the main purpose of the iPhone is its fundamentals, that it is a phone that you need to use. The same thing about short squeezes. Whenever you're investing in a company, and it's not just for short squeezes, in general, if you see some technical things happening, which most of the time I don't see, but if you see it, based on the fundamentals first. So let me know in the comments, what do you think about short squeezes? Do you have any examples you would want to talk about? We are going to talk about that maybe in the future in another video. Actually, the idea for this video came from my Discord group. Someone was talking about short squeezes, about Blue Apron. Then I decided to look into it and decided to make a video about short squeezes in general. So thank you for watching this video. Please like, subscribe and share. Please watch these two videos if you have missed them. Have a nice day and goodbye.